The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar entitled The Secure Act, Part 1. The webinar will last approximately 30 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sujas. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. And here he is.
And thanks, Jennifer. And hello, everyone. We're glad you're with us today. If you're like Jennifer and myself, over the past 45 days, among other things, you've been devouring as much information as you can about the Secure Act and the companion stuff that was made part of the spending package that was passed by Congress and the President back in late December. We hope that much of what we'll cover today is review for you, but you may hear some new things or some new details about things that you already knew. That would be good too. This is part 1 of the Secure Act seminar. We're going to spend about 30 minutes today covering everything that is not stretch. In part 2 next month, we will spend time on stretch. That's on March 4th, as you can see on your screen. And that one's going to take longer. There's a lot of nuance to the new stretch rules, a lot that needs to be covered, and that will take the better part of an hour. So we invite you to join us next month if that's of interest for you. But here's a kind of a quick overview of what it is that we're going to be talking about today. First of all, we're going to do a bit of a background on the Secure Act and its companion provisions. We'll talk about the change in IRA contributions. They now may be made after age 70 and a half. We'll talk about the change delaying minimum distributions until the year in which the taxpayer turns 72. We're going to talk about, wait a minute. I gotta look. We're going to talk about some of the pension changes. We're going to talk about the change in 529 plans, the fact that the loan repayments are now, at least in a limited way, considered to be a qualified distribution from 529 plans. We're going to talk about the changes in the kiddie tax rules. We'll talk about how Congress and the President decided that plan administrators don't actually have to update their plan documents for a little bit. We'll talk about the reversion and rules about medical expense deductions. We'll talk about some more of the pension changes, and we'll talk about the conclusions that we want to make with regard to all the changes that have been made. So in any event, let's start with the background on the Secure Act and the spending package. And that begins with the fact that, as I mentioned, on December 20th, President Trump signed the Secure Act along with a broader spending package. The Secure Act has provisions in it that will be of importance to those of us who are in the life insurance and the financial services business, and we're going to talk about those today. And we're going to start with the fact that IRA contributions are now allowed after age 70 and a half. Under the old rules, once you hit a year in which you turn 70 and a half, you were no longer eligible to contribute to a traditional IRA. Now that the Secure Act has been passed, a person may contribute to a traditional IRA as long as she or he have earned income regardless of their age. And this is true even if the person is already taking minimum distributions from her or his IRA. That's a straightforward change that is, I think, good news for many of our clients who want to continue saving for retirement, even though they are technically at an age where retirement should have begun, at least from the federal government's perspective. The change is favorable. There is one little nuance that has to do with QCDs, qualified charitable distributions. Now, as a reminder, under the old rules and under the continuing rules, you can send money directly from your IRA to a charitable organization, a 501c3 organization, if you're older than 70 and a half, of up to $100,000 a year. A QCD does two positive things for a taxpayer. The first positive thing is that any QCD transfer to a charity goes towards satisfying the taxpayer's minimum distribution requirement for the year. And the second positive thing is that QCDs don't hit the taxpayer's income at all. Well, Congress and the President, because they now allow for the potential for deductible IRA contributions after age 70 and a half, said, wait a minute, we're not crazy about the idea that somebody might be able to kind of manipulate this to get a charitable deduction, effectively get a charitable deduction in a way that is unfair. And so they've got a specific provision of the Secure Act, which you can see the language on the screen. It looks a little bit confusing, as most parts of the tax code are. It says the amount of distributions not includable shall be reduced by an amount equal to the excess of the aggregate amount of deductions under Section 219 for IRA contributions after the date the taxpayer attains age 70 and a half. And then that's adjusted by the aggregate amount of reductions. Well, how do you suss that out? What does that really mean? Well, what it means is beginning with the year that a taxpayer turns 70 and a half, the person's got to keep track of all the deductible traditional IRA contributions that the taxpayer made. And those contributions are treated as taxable distributions that first come out of any qualified charitable distributions. Here's an example. So let's say Susan was born June 1st, 1950, and she's going to turn 70 and a half in 2020. She's got earned income, so she makes deductible IRA contributions for 2020 and 2021. She's now allowed to do that under the new law. And that's a total deductible contribution of 14 grand. Then in 2022, Susan directs the custodian of her IRA to make a QCD to her church, 50 grand. So under the rule, the first $14,000 of that QCD is not treated as a pre-tax QCD. It's going to be included in Susan's income as a taxable distribution. That is, that Susan is recovering her contributions that she made, her deductible contributions that she made to an IRA after or beginning with the year she turned 70 and a half. The other $36,000 in excess of the 14 grand is excluded from income, and the entire $50,000 gift goes towards satisfying her 2022 IRA RMD. And going forward, if Susan makes no more deductible IRA contributions, all of her future QCDs will be pre-tax because she will have recaptured all of her post 70 and a half IRA deductions. So there you go. That's a little nuance that maybe you hadn't seen before. That's how it works with an example. Let's go ahead and move on. Let's talk about the delay of minimum distributions until age 72, which is the other non-stretch change that I think most people are talking about. So the year for which minimum distributions must begin is now the calendar year in which a taxpayer turns 72, not the year in which a taxpayer turns 70 and a half. As an aside, the still working rule remains unchanged. If you've reached 72 and you're still working for an employer, but you don't own the company, then you can delay RMDs until the year in which you separate from service. Now, here is a much asked question, one that I got at least one email about prior to today's webinar. If you have a client who turned 70 and a half in 2019 or earlier, they don't get to delay future RMDs until age 72. You got to keep on going under the old rules if you turn 70 and a half in 2019 or earlier. The new rules apply to those who turn 70 and a half in 2020 or later. Here's a quick example. So Stanley turned 70 and a half in 2019, did not take his first RMD yet from his IRA. Well, he's got to do that by April 1st of 2020, and his second RMD is due by December 31st of 2020. Now, Oliver, who's a little bit younger, turned 70 and a half in January of 2020. His first RMD will be due for calendar year 2021, the year in which he turns 72. He chooses, he can wait until April 1st of 2022 to take his 2021 RMD. And of course, his second RMD will be due by December 31st of 2022. Okay, so, explaining that to our clients is semi-straightforward, but to make things even more complicated, the IRS has published new life expectancy tables, which will be used to calculate minimum distributions beginning in calendar year 2021. So they don't apply yet. They do apply beginning in 2021. Those tables will allow taxpayers to take smaller distributions than required under the current table. So for a living taxpayer, the new uniform lifetime table that will be effective beginning in calendar year 2021 will generate slightly smaller RMDs for taxpayers at the same ages as they would have been calculated under the old tables. So it's important to know. So let's go on and talk about some of the less common, less known changes. Let's talk about the pension changes. And let's start with the new child exception to the penalty tax. The Act creates a new exception to the early distribution penalty for distributions of up to $5,000 from qualified plans, and this is referred to as the qualified birth or adoption distribution. And to qualify, the account owner must take a distribution during the 1-year period beginning with the child's date of birth or under which the adoption for a minor is finalized. In order to be able to take a qualified plan distribution that qualifies for the exception, the person has to be entitled to a distribution. Just because there's this exception of the penalty tax doesn't mean that a participant in an employer plan is entitled to a distribution. So that's still a standard. But if they are entitled to a distribution, they can qualify for this exception to the 10% penalty tax. And then there's one thing of note. Apparently, if somebody takes a distribution under this rule of up to $5,000, the distribution can be repaid to the plan or to the IRA in the future. And the Secure Act doesn't give any time limit under which the repayment to the plan or IRA may be made. So apparently that there is no deadline for that. The $5,000, up to $5,000 can be put back in. Another change to pensions is now that it's easier for annuities to be included as an investment in a pension plan. Annuities have always kind of been allowed. A plan can own one or more non-qualified annuities as investments. But a lot of times employers and plan administrators have been reluctant to have annuities owned as a plan investment because of fear that the underlying issuing carrier might go insolvent. The Secure Act provides some lawsuit protection so that a plan administrator can select an annuity to be owned by the plan without fear of being sued, basically giving the plan administrator immunity in the event the carrier that issues the annuity goes belly up. And so the bottom line there is that annuities might become a little more popular as an investment inside of qualified plans. Another change with regard to pension plans is that small employers, it's easier for them to join together to offer pension benefits to the employees of all the companies. Probably will have the greatest impact with regard to Section 401k plans. We'll see, how many carriers offer such multi-employer plans, and other prospective plan administrators will offer these types of plans. The rules are designed to make it easier for small businesses to offer the plans, but of course, they can only offer what carriers will permit them to offer. So that has to be thought about. We'll see how that shakes out. But at least in theory, multiple small businesses will be able to join together to offer pension benefits to their employees. There's another change, and that is that there are some tax credit increases with regard to small businesses that offer pensions to their employees. One tax credit is that there's a $500 available for small businesses that automatically enroll all employees in employer-sponsored deferral-based retirement plans like 401k plans. Now, that doesn't mean that all employees actually have to participate, but that the default for the employer is that all employees are going to be included. The employees can opt out by doing some kind of an affirmative act, but that's the way that would have to work for the business to qualify for the credit. If a business implements a new qualified plan that includes non-owner employees, there's an enhanced tax credit available. It used to be the tax credit was $500 a year for the first 3 plan years, or up to $500 for the first 3 plan years. The maximum available is now $5,000 for the first 3 plan years. So your mileage may vary. The employers have to jump through hoops to qualify for the credit, but an increased credit is there, and it's good for us to know about it. What other changes were made as part of the pension change package? Part-time employees now eventually will have to be included in qualified plans. Used to be that you could exclude part-timers who had not worked $1,000 a year, didn't matter how long they were with you. Now those who work at least 500 hours in 3 consecutive years do have to be included, or will have to be included, but the first year that you count is 2021. So this won't actually go into practical effect until calendar year 2024, but you need to be aware of it. The other thing is that most retirement plans have a December 31st implementation deadline. For beginning in 2020, employers who adopt new plans that are solely employer funded, right? They don't have any deferral money that the employees put in, but are solely employer funded. They now have a due date for implementation up to the employer's income tax return filing deadline, including extensions. That's always been the deadline for separate implementation, but now more complex plans that are solely funded with employer money. That's the deadline for all such plans. So let's talk about the change to 529 plan rules. In the past, we got a lot of questions about this here in our office. 529 plan distributions, while they could be used for direct expenses like room and board for higher education, you couldn't use distributions to repay student loans that were incurred for expenses that were incurred in prior years. Now you can, but there's a limit. It's a $10,000 lifetime limit that applies to each 529 plan beneficiary. And if earnings are used to repay loans on distributions from the 529 plan, then it will reduce the potential for the student loan interest deduction. So the good news is that $10,000 is available to repay loans. For those who have sizable loans, this is good news, but not great news. And then, there's the offsetting thing is that loan interest deduction is more limited for some of our clients. So let's talk about some of the other changes that are, again, perhaps less important for some of our clients. Let's start with the kiddie tax reversion. I apologize for the slide having incorrect information. The bottom line on the kiddie tax reversion is that instead of trust income tax rates being used to calculate the kiddie tax, it'll again be the parents' rates, and that is retroactive for the years in which we've used the trust rates. So there you go on that. Let's talk about another aspect of plan document delay. The Secure Act changed the beneficiary stretch rules and the age 72 and changed the age that RMTs have to start. That's effective immediately, but the deadline to amend plan documents to reflect those and some of the other changes made by Secure in for-profit companies is January 1st, 2022. Most for-profit companies, January 1st, 2022. For governmental and collectively bargained plans, they've got longer. The government gave itself more time to conform to the rules that it imposed, which I think is hilarious, but in any event, there you go. The medical expense threshold has been changed. And again, this is one of those changes that was retroactive. We thought that the medical expense threshold for itemized expenses in 2019 was 10%. Well, as part of the spending package, they retroactively reduced the threshold back to 7.5% for 2019. It is 7.5% for 2020. So if you've got medical expenses in excess of 7.5% of adjusted gross income, the amount in excess of the threshold is a potentially deductible itemized expense. Those of us on the call who've been paying attention for the past couple of years know that because the standard deduction is a lot bigger in 2019 and 2020 than it was in 2017, fewer of our clients are actually itemizing their deductions. But for those who do, who has significant medical expenses, it's good to know that medical expenses are deductible as an itemized expense in excess of 7.5% for last year and for this year. The threshold scheduled to increase back to 10% in calendar year 2021. Congress and the President have decided that it would make the rules regarding who can contribute to an IRA slightly more liberal. Graduate students may now consider taxable non-tuition stipends earned income for the purpose of figuring out whether they're eligible to make Roth and traditional IRA contributions. In the past, they weren't able to do it. Now they can do it. So that's a slight liberalization of the IRA contribution rules. So what are the conclusions that we should draw with regard to the changes that have been made? So as with most other federal legislation, there are some opportunities that have been created. We spent a lot of time and effort on change in minimum distribution rules. The year in which a taxpayer turns 72 is now the standard for those who are turning 70 and a half in 2020 or later. QCDs are still available beginning with age 70 and a half or older, taxpayers actual age 70 and a half or older. And I think the QCD story is a strong one. The advantages of QCDs are definitely there. But if you've got somebody who plans to make QCDs and also is still working and plans to make traditional IRA contributions, telling them about the interaction of the two, I think is an important service to be able to tell your client. Second thing is that our business owning clients who have pension plans, especially 401k plans, they've got an extra reason to consider making non-qualified annuities part of the investment mix. For those who don't have full administration plans, there are some new tax incentives available that make those plans look more inviting than they have in the past. The retroactive changes to the kiddie tax can make more sense for high income clients to take a look at whether amending a prior year's return makes sense. And then the last thing is our best clients aren't going to know that some of the details that we know about the Secure Act. And for those of us who are in this business, it's really an opportunity to go visit with them, tell them about the new provisions, answer their questions, figure out how the new rules affect them. I think it's incumbent on us to, study closely the provisions of the Secure Act that are relevant for our best clients so that we can help serve them better. As I said, this month, we've talked about the non-stretch provisions of the Secure Act. Next month, we will discuss specifically the stretch provisions, which I know there's a lot of information, a lot of questions about. We'll talk about that during next month's webinar, and we'll spend a little longer next month talking about that. Thank you for being part of our webinar today. We will post today's webinar on the web. Jennifer will tell you more about that. And Jennifer, if you would, please take us to conclusion here.
Thanks, Linus, and thanks for joining us today. And please remember to register for next month's webinar, the Secure Act Part 2, where we'll be covering the new stretch provisions. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 224-1291. And as Lena said, we will post this on our YouTube channel as well as next month's webinar. And if you are interested in subscribing, please do so. Thanks again, and best wishes for continued success.